Great. So welcome you all to today's section. Today we are going to look at preparation of cash flow statements. That is the statement of cash flow. That is today's section. Statement of cash flow. So statement of cash flow. Great. Okay. Good. Statement of cash flow. That is today's section. Great. So let's continue to do statement of cash flow. That is today's section, basically. Now, to start this, usually ask this question: is profit equal to cash? Profit is it equal to cash? So is profit equal to cash? The answer will be no. Sometimes to yes. Good. Here it depends on the basis of the financial statement preparation. We have used the accrual concept to prepare the financial statements. So for that matter, definitely profit will not be equal to what? Cash. So once you use the accrual concept to prepare your financial statement, profit is not equal to what? Cash. However, if you use the cash basis to prepare financial statement, profit is always equal to cash. Great. And most financial statements are prepared on what? Accrual basis. So definitely our profit will not be equal to cash. So the question is, then if profit is not equal to cash, how do you reconcile this difference? So to reconcile this difference, we have to prepare a statement which will spell out all cash transactions right from the beginning of the year up to the end of the financial year to know whether the cash balance stated in the financial statement is the right cash balance. That's all. Good. So basically, that is the reason. Now, assuming that you are the accountant of NGO or a church, then you prepare the financial statement and tell the owner or the boss that you've declared a surplus or a profit of 500,000 for the year. 500,000 cities. That's the profit or the surplus. And they ask you what's the cash balance. So the cash balance is just 150,000 cities. They'll ask you what's the remaining balance. Yes. And Mr. Accountant, where's the remaining balance? Good. So to explain to the owner why the remaining balance was passed, then you have to prepare a cash flow statement. So cash flow statement is there to reconcile the difference between profit and what? And cash. So cash flow statement is a statement that we prepare to reconcile the difference between profit and cash. So the cash flow statement is prepared to reconcile the difference between what? Cash and profit. So to bring this difference into a successful agreement, you have to prepare a cash flow statement. Perfect. Now, cash flow statement, as the name suggests, cash flow. It's just a statement that we prepare to show the movement of cash in and out of the organization. So that is cash flow statement. That is the cash flow statement. Great. Cash flow statement. So now we know the reason why we prepare what cash flow statement, just to solve the disagreement between profit and what and cash. Okay. Now let's see. Now you said profit is not equal to cash. Let's look at some causes of such difference. Causes of what? Such difference. So let's see. Causes. So why do you think will cause a difference? What are the transactions that will cause difference between profit and cash? It means that such transaction affect only one. So if there's any transaction in accounting books which affect only profits, cash will not be affected, then it will cause a difference. If there's an accounting transaction that affects only cash, it also costs difference. So item number one, that's the basis, the accrual basis. So accruals. Some of the items you have not paid for it, but it has been reflected in your profit and loss. It will be subtracted from the profit. So definitely it will let the profit figure be different from the cash. So accruals, expenses owing, prepaid expenses, all of these will cause difference between the profit and then the cash. Great. Two, non-cash item. Non-what? Cash item. Non-cash item also cause, let's make it cash items. Examples of non-cash items. One, provisions. Two, depreciation. Impairment. Amortization. Inventory written down. All of this will cause difference in the between the profit and then the cash. Non-cash item. Allowances. Provision for bad debt. All of these causes difference between the profit and then the cash. Great. So that is it. Now, the third item that usually cause difference between profit and cash is capital expenditure. Capital expenditure. And we did that under IAS 16. We've explained capital expenditure. So, capital expenditure. Now, with the capital expenditure, if you buy assets, cash will be reduced, profit will still be the same. Because in the profit and loss or the comprehensive income, assets are not recorded there. So the profit will still be the same, but your cash will be reduced. So that is it. So it will definitely cause difference between profit and cash. And then repayment and acquisition of loan. If you go for a loan or a facility, your cash will be increased, but profit is still the same. Great. So these are the few causes of the difference between profit and cash. So that is it. We are done. Now, holiday assignment or trial. Just give me three important of cash flow statements. Yeah. Give me three important of cash flow statements. Some accountants want to know the usefulness of preparation of cash flow. So state three importance of preparation of cash flow. Its inclusion in the financial statement. Now we said that a complete set of financial statement must comprise of what? Your comprehensive income, change in equity, financial position, and your cash flow plus your notes. So that is it. Okay. Um, so before I move on, let's look at the definition of two terms stated in here. So cash. Who will define cash for me? Yes, cash. Cash. Any definition for cash? There are two terms that we have to define here, or know them very well. Cash. Because we are paying what? Cash flow. So you should know the meaning of what? Cash. But the flow there is just a movement. Left with the cash. So the second item is cash equivalent. Cash equivalent. So that is it. Cash equivalent. Okay. So first cash. Any trial, cash. Any trial for cash. Mm-hmm. Wait, cash are current assets. I'll pick that. The standard define cash as cash in hand and then the cash at bank. That's all. That's a demand deposit. So cash comprised of cash on hand and then demand deposits. So that's the definition for cash. So what exactly? Good. So the current account, it must be the demand deposit. Demand deposit. That's the cash. So in fact, just cash on hand and demand deposit. Demand deposit. Good. So we are done. Then let's go to cash equivalents. Now, cash equivalents, as the name suggests, they are not cash, but they are equivalent to what? Okay, so they can replace cash if cash is not there. Yes, but there's a saying that if you send maybe a hen or a chicken to go and buy fish for you, and then there's no fish, and the chicken too, you can use it as a fish. So if you're looking for cash and cash is not there, the equivalent. Good. So let's see the definition for cash equivalent. They are short-term, highly liquid investments. So they are what? Short-term, highly, wow, highly liquid investments. So liquid what? Investment. Short-term, highly liquid investments that are rarely convertible into known amount of cash without significant changes in the value. Without significant changes in the value. That is what cash equivalent. So they are short term, within 12 months. You can convert it into cash. Maybe you have government 91 days treasury bills. You can classify them as what? Cash equivalent. That is it. Cash equivalent. They are highly liquid investments. Easily can be easily converted into cash, which can be converted into cash without significant changes in value. If I have 1,000 Ghana cedis with Bank A or Yansa Bank, and then within 12 months, I can go for my 1,000 Ghana without change in value. I can classify it as what? Cash equivalent. But if I have 1,000 Ghana with you, and then within 12 months time, you will give me 800 Ghana cedis instead of the 1,000 Ghana. There's been a significant changes in the value. So this is not cash equivalent. I will not say that 800 is equivalent to 1,000 cedis, not at all. So it's not what cash equivalent. That is it. Great. So the investment that you have with that facility or that group, if you can go there anytime and demand for your funds without tossing and without changing the value or without reducing the value for you or without discounting it, then it can be classified as what? Cash equivalent. Great. Now let's start the actual game. Now, for cash flow purposes, the organization's activities has been grouped into what? Three. For cash flow purposes, the organization's activity has grouped into three. Unlike the profit and loss, where we have just one section. So we have three perspectives. So we have the operating activities, operating activities. That's the first one. Second one, investing activities. Then the last one, we have financing activity. Good. So for the purpose of cash flow, the organization's activity must be grouped. So if I add cash flow from operating activity, so much. Cash flow from investing, so much. Cash flow from financing, so much. At the end of the day, this is a total cash movement. We are done. Good. Now let's see. Now, we should know the operating activities, what goes in there, so that our question, we have to assemble all of them at one position and find their net figure. We are done. Cash flow from operating activities. With this, we are talking about cash or funds coming from your principal activity, your ordinary course of business, what you raise your business for, your core operating activity. That is all. Money is coming from your core trading or your core activity, the one that we call it what? Cash flow from operating activity. We are done. Now, what are the examples? Let's give examples and cash flow from operating activity. So, examples. So, examples include one, cash sales. Cash sales. Cash sales. Two, cash received from customers. Cash received from who? Customers. Then three, cash paid to your suppliers. Cash paid to suppliers. Cash paid to suppliers. Cash received from customers. Cash paid to suppliers. Then four, operating expenses paid. Operating expenses paid. Example include administrative expenses, distribution costs, rent, wages and salaries, and then the other costs. All of these form part of what? The operating activities. Then you go to tax paid, then we can add interest paid. Now, interest, let me explain interest very well because it swings. So, interest paid. Now, if the nature of your business is in connection with paying and receiving of interest, and then when you pay interest, it forms part of your core activity. How we get it? Good. Example include most financial institutions like banks. Yes. Paying of interest is part of your core activity. So it must be part of your operating activities. Great. However, if paying of interest is not part of your core trading or core activity, then you only pay interest when you go for finance, when you go for what? Facility or loans elsewhere. So that one will be what? Financing activity. So that means interest paid can be classified under operating activity or financing depending on the nature of your business. How we get it? Good. Just that if the examiner does not inform you, so you do have two positions, financing or operating, but you can include it in what? Operating activity. That is it. And we might not tell you the trading activity of the entity. No, we don't tell. Just success limited. Impuntio, it's well. Great. So that is it. Okay. So we are not going to tell you the activities. However, you can place it either under operating activity or financing. How we get it? By the moment that disclose to you that this is a bank or a financial institution, then assume that the interest paid is part of what they are core operating. Yes, but in most exam case, we don't disclose whether they are financial institution. We just mention Impuntio Limited, this limited, then we are done. So take note. So if you see this in a question, just assemble them, you are done. These are what the operating activities. Your core can include tax. Yes, so tax has been imposed as what core activity because you have to pay tax. Yes, you have to pay tax. So it's part. So tax paid. Any business at all you do, tax form core activity. Yes, so that is it. Now let's go to investing activities. Investing activity. You know, even though you are not in to be buying and selling vehicle, sometimes it's very useful to dispose the abandoned vehicles. So such disposal is not coming from direct trading. You are not selling and buying vehicles. No, you deal with public provisions. But the delivery van is too old, so you decided to dispose it off. Great. Now, investing simple means opportunities that you took advantage of. That's all. Opportunities. So investing just talks about asset acquisition and disposal of what non-current asset. Anything that has to do with what acquisition and disposal of what non-current assets. That is investing activity. So investment activity examples will include one, acquisition. Acquisition of what? So let's make it acquisition and disposal. Disposal of PP or non-current assets. So examples of examples of investing activities. Acquisition or disposal of PP. Two, store acquisition and disposal of investment, long-term investment. Investment. But here it includes non-current assets. Sorry, it includes tangible and then the intangible. So intangible assets. It also include intangible assets. Then three, all the other income received, they must be part of what investing. All the other income. So you can give example. Interest received, dividend received, and investment income received. So here dividend, interest, And then investment income received. The underlying word is what? Received. Not earned, received. So that is it. So these are what? The investing activities. Investing activities. We are done. It just talks about non-current assets. Everything about non-current assets. So just go to the non-current assets section. Any item there is an what? Investing activity. We are done. Let's go to financing. Financing. With the financing activity, it just talks about where you get the funds to finance the acquisition of the non-current assets and your operation, your core activity. Good. So that is it. So basically, examples of financing activity include what? Raising of what? Capital, long-term capital. That's all. Raising of long-term capital. So example of financing activity. So example one, it talks about equity and debt, long-term debt. So acquisition of shares. So issue of shares. So issue of shares. Two, acquisition of loans. Of loan or long-term debt. That's all. Now, any cost relating to these two items, there must be a finance cost. So financing activity. So three, issue cost or transaction cost. Issue cost, issue or transaction costs. Transaction cost. That is it. So the shares that you've issued, you pay the brokerage fee or listing fee. It must be a financing activity. The loan that you took from the bank or the facility, there was a administrative charges or transaction cost on the facility, so which must be part of the financing activity. Then almighty, dividend paid. Dividend paid. If you don't deal with dividend related transactions and you pay dividend, it must be under financing. Good. So this is return on equity, and return on debt is what? The interest. So the number five is what? Good. Number five is the interest paid. Interest paid. So now we know where the items will be. Interest paid, that is if I'm not interest related entity, right? And we pay any interest, it means that it's as a result of acquisition of loans or facilities that results the interest payments. So that is it. So these are the financing activity. Then you are done. Great. Now let's start the actual game. Let's start the actual game. Good. So in summary, if operating activity talks about your core purpose, then these items must be in the P&L, the profit and loss, the income statement. These two are on the financial position. This non-current assets, financial position item, financing, equity and debt. So that must balance nicely for you. So equity and what? Debt. That's all. So this So it means that the financial statement that we prepared, that is what we are going to use to prepare the cash flow. Because P&L, we know how to prepare P&L. These two are the financial position. We know how to prepare them well so that we can proceed. So that's why we did that one first. So here the examiner assumes that you are very good when it comes to comprehensive income preparation, and even aware that we did it last week and then we even give a work and then we've done it. So it has been worse the case. So now when it's starting question on cash flow, it's free to go, move any angle because you are very good at that. Yes. So the examiner is aware. So that is it. Okay. Now let's start the cash flow from operating activities. Now the preparation of the cash flow statement. From operating activities, we have two methods, two solid methods. The methods are, we have the direct method and what? The indirect method. For our case, you should know all the two. Good. The direct method and what? Indirect method. So let's look at the direct method. So the two types has to do with only the operating activities. The remaining two, investing and financing, we don't have direct, we don't have indirect. That one, just one preparation that can how we get it. So in exams, when they ask you to prepare the direct and then you have no idea, just do what you know. That's all. You only get the operating activity wrong. It's far better than losing everything. Good. So that is it. So cash flow from operating activities using what? The direct method. Let's see. So cash flow from where? Operating activities, OA. Please, no shortcut in Netherlands. Take note. If I write OA, I'll just add TNT to it. OA, travel and transport. It's a circle. So take note. No shortcut in Netherlands. Okay. Yeah, I'm going to use the direct method. Using the direct method. Using the direct method. So, direct method. As the name suggests, everything must be what? Direct. Yes. So here we are using cash flow. Actual cash flow. That is the direct method. We are using what? Actual cash. Actual. They are not passing anywhere. So actual cash movement. Actual cash flow. That's what we call direct. You are not passing anywhere to obtain the cash flow. The actual money received, actual money paid, that's all we are done. Yeah, that in some cases, such information might not be readily available. Good. So that is it. Great. Okay, now let's continue the game. What will be the format? As we said, direct. So the format will be like this. In fact, if cash is coming in positive, it's going out negative. That's all. So cash sales. So much currently. So cash sales, so much. Put it there. Then cash received from customers. Cash received from customers. Cash received, so much. Then your cash paid to suppliers. Cash paid to suppliers. Paid to who? Your suppliers. Because it's an outflow, I'll put it in brackets. And then operating expenses paid. Operating expenses paid. That is the admin and distribution cost paid. Admin and distribution cost paid. We take them off get what you call operating cash flow before interest and tax. Operating cash flow before interest and tax. Operating cash flow before interest and tax. So take note. Its counterpart is the profit before interest and tax. Good. You put it here. You put it there. Then when you are done, the last two items, that's the interest, because if this cash flow is before interest and tax, then the next junction will be what? Interest, right? Okay, that's the cash flow. So therefore, interest paid. Here, everything must be cash, either paid or received, not incurred. No, you don't bring incurred here. No incurred. Interest paid. Everything must be paid or received. You're looking for money. There is no money received or money paid. Don't even make it in here. Or convert it and get the actual money paid or actual money received. We are done. So interest paid is an outflow because money is moving out. Then you go to tax paid. So tax paid. Tax paid to money is moving out. So that is it. Tax paid. Okay. Putting all this together, we have what we call net cash flow from where? Operating activity. So net cash flow from operating activity. So we call it net cash flow. Net what? Cash flow. If you want trouble for yourself, tell the examiner that it is cash inflow or outflow. If it is positive, it is what? Inflow. If it is negative, it is what? Outflow. But if you don't want trouble, just tell the examiner it's what? Net cash flow. Whether inflow or outflow, leave it for him to decide. Yes. Because if it happens to be negative and you write inflow, then there's a mismatch there. The net cash flow from where? Operating activities. So that's all. Then you are done. Great. I am done. So let's back with what? Illustration. So let's go to the material and back it with what? With illustration. Okay. We are going to back it with what? Illustration. So let's see. Let's back it with what? With illustration. Okay, so first illustration. Chunks Limited, example 1, page 4. Chunks Limited, example 1, page 4. Now let me explain this. These two guys, this we use formula or workings. You have to do some small workings for them. Then you are done. So let's go and look at that question. So example 1, Chunks Limited is preparing its statement of cash flow using what? The direct method, and has provided this information to you. Credit sales is there. Trade and other receivable at the year end is there. Trade and other receivable at the beginning is also there. Purchases on credit is there. Trade payment at the year end, at the beginning of them are there. Operating expenses incurred. We want what? Paid, not incurred. What do you have to do? So you have to convert it. So it means that we have to convert or do something about the incurred to get what? Paid. Yes, because you're looking for money, movement of money. So you're not going to entertain any non-cash movement. Accrued expenses at the beginning, at the end of them are there. Depreciation of PPE. Good. So it means that the expenses incurred, it includes depreciation. Operating expenses include what? Depreciation. So what do? We have to take it off to get the operating expenses paid. So the operating expenses of what? 6,000 series, they've already include what? Or they've added the 1,200 to it. We take it off and get the actual operating expenses paid. So that is it. And tax paid is there nicely. We are done. So prepare cash flow for operating activity using what? Direct method. So let's start with. So let's start again. Let's start the game. Okay. So I see the Chucks Limited. So statement. Let's say cash flow for operating activities, right? Let's go and look at the requirements. Prepare cash flow from where? Operating activity. So the heading will be cash flow from operating activities. Cash flow. Cash flow from operating activity. Those of cards in exam. Reporting currency. You are reporting what? Ghanaian cedis. We said that the format says, we need all cash received one side, all cash paid. Take it out. You are done. The first cash is the cash sales. So let's see. But when we scan through, there's no cash sales. So I'll move on. There's no cash sales. It means that the whole period, most of the sales or all the sales were on credit. Good. So if there's no cash sales, then let's move on to the next item. Cash what? Cash received. Cash received from credit customers. You have to pause and go into workings on them. Now there's one good news about cash flow statement. Cash flow statement is a bit okay. Their workings are straightforward. There are 3 steps. So workings. So first working on the list will be 1. Cash received from customers. So that is. Anytime you're looking for something received or something paid, 3 steps, you are done. Only 3 items that you need. First, get the opening balance of that item. Second, get the movement. Third, subtract the closing balance. You are done. Whatever remains, give you a cash received or cash paid. So first, open balance. Now, cash received from customers. Which transaction or which balance in the financial statement that it relates to? It relates to receivable because your customers, they are receivable, right? Good, or debtors. So get the open balance of receivable. So open balance. So write it there. So much. So Ghana cedis. Good. So let's go and pick the open balance from the first step. What is the open balance of the open balance of the receivable? So let's see. And the closing balance. So trade and other receivable at the year end, that's the closing balance. Trade and other receivable at the beginning of the year, 5,000. At the end, 3,000. Credit sales, 20,000. We are done. So let's go and then include it. Open balance 5,000. Then I'll add my credit sales to it, or sales, credit sales, or just total sales, which happens to be what? Oh, so 20,000. Then less closing balance. So closing balance, which is what? 3,000. So please let this format be part and part of you. Anytime looking for something paid or something received, that item is open balance. The movement here, I normally call it the P&L phase. So this one goes to the P&L. Closing balance. This will be the financial position, balance sheet. This one will be on the balance sheet for you. Then you are done. The financial position, the open balance, and that item to it, let the closing balance. This is interpretation. At the start of the year, customers that owe us amount to 5,000 Ghana cedis. They owe us 5,000 cedis. And the same year, we give them goods on credit of what, 20,000. So in all, they are owing us what, 25,000 cedis. Okay. At the end of the reporting period, 3,000 are still owing us. Okay, so that means some people pay though. That's why only 3,000 are owing us. So that's why we're taking the 3,000 from the entire one, giving us a balance of what? 22,000. So that's the cash received from where? Customers. So I'll come here and come and then include it in the, so let's call it cash received. So workings, in fact, open a bracket, workings number 1. Examiner, please go to my workings 1. You see it there. So 22,000. Okay. The next one is cash paid to suppliers, right? So if anytime looking for something paid or something received, just get their opening balances and their closing balances. You are done. Okay. So with cash paid to suppliers, suppliers are who? Trade payable or the creditors. So let's pick the details. The format will still be the same. Then you do it for me. So here I just have to claim this and claim what? Credit sales. Everything will still be the same. I'll just call it cash paid to the suppliers. So that's the note 2. Everything. So note 2. Note 2, cash paid to suppliers. So cash paid to suppliers. Great. So the cash paid to suppliers, tell the examiner that the opening balance will be what? So let's go and pick the suppliers opening balance. Add the credit purchases to it or the entire purchases. So credit purchases, all of these P&L. Then less what? The closing balance. You are done. So closing balance. Great. Now let's see. So closing balance. So let's go to the question to pick these details from. Trade payment at the end, 3,800. At the beginning, 4,000. Credit purchases, 8,000. Okay, so all of them are there. So let's go and then include it. Good. The opening balance is the 4,000 Ghana cedis. Purchases is 8,000. Or they give us 12,000. If at the end of the year, only 3,800 people are still owing us. That means some people paid, but we have paid them. That means we paid an amount of So 8,200, right? Agreed. So this is what we will call it was cash paid. So cash paid to the suppliers. That is 8,200. Then we adjust. So keep the format short and brief. So 8,200. Take it off. But let's continue again. Let's go to operating expenses paid. Operating expenses paid. Operating expenses paid. So that will be workings number 3. Operating expenses paid. As usual, anytime looking for something paid, look for that item, its opening balance, its closing balance, and then the incurred version in the profit and loss, what went to the profit and loss statement. So let's see. So looking at this question too, we have accrued expenses there, right? It relates to the operating expenses. Good. All of them are what? Expense. So accrued expense at the end of the year and then at the beginning of the year. So at the beginning is what? 1,000. At the end is 800. And then the expenses incurred is the 6,000. Just that this 6,000, we have to less the depreciation from it before we get in to get the expenses paid. Okay. So basically, that is the opening balance is 1,000, closing balance is 800. So here we will tell the examiner that operating expenses paid is nothing by bringing 3 items together. Item number 1, opening balance. So with the opening balance, we will have something like opening balance happen to be 1,000, right? 800. Go. So opening balance is 1,000. Then tell the examiner that expenses incurred. In bracket, they've incurred 6,000 less what? 1,200 because of the depreciation. Depreciation is non-cash item. It does not have cash movement. So what we do, we take it from the incurred to get paid. So 4,800. Then we finally less what? The closing balance. So what is the closing balance? So closing balance. Perfect. The closing balance happens to be 800. So we take it off. Then we get a 9 figure of what? 5,000. So this is the cash paid for the operating expenses. Great. Okay. So basically, this is how we will get it. Okay, so this is workings number 2, W2. This is workings number what? 3. 5,000. I'll take it off and now tell the examiner that this answer is for operating cash flow before interest and what? Tax. And that one will give us So 8,800. Then what next? Interest paid. Do you have interest paid on the list? Interest, no. Okay. Then move on to tax paid. Yep. There's tax paid of what? 3,200. So here I want to look at this. For this tax paid. Tax paid is 3,200. So finally we have 5,600 as well. Net cash flow from where? Cash flow from operating activities. If one trouble, it is on the net cash inflow because it was positive. It is positive. I don't want trouble. Just end at the net cash flow because I'm not there. Okay, I am done with the direct method. It's so straightforward with the direct method. Let's go and look at the other method called indirect method. Then we are done. Good. The indirect method, as the name suggests, indirect. Now we pass through, we use the kitchen to enter the building. Yeah. Good. That one indirect. So we take the profit and massage the profit to get what? Cash flow. That's all. That is the indirect method. Direct method, we pick direct cash flows, actual cash flows. With the indirect method, we pick what? Profits. One of the profits. There are so many types of profits. Gross profits, operating profits, profit before interest and tax, profit before tax, profit after tax. You pick one of these profits and massage it. And it will give us what? Cash. That's all. So let's look at the indirect method. The indirect method here. I'll do that one here. Indirect method. Indirect method. Great. With the indirect method, we, as the name suggests, we are going to pick profit before tax or one of the operating profits and massage the profit. Good. So in direct method. So don't forget that the direct and then the indirect method have to do with what? Only cash flow from where? Operating activities. Good. Indirect method. Now we said that profit is not equal to cash, right? Good. So if I pick profit and massage it with the difference, three differences that we explain, then I will get what? Cash. So you pick this profit so much and adjust it, massage it with three items. With three items, then you attend. Items such as one. So if you pick the profit, massage it or adjust with the following items. Items number one. First item on the list, non-cash item. So non-cash items. So any non-cash items that have been reflected in the profit, let's reverse it. That's all. So if they have added certain non-cash items to the profit or they have subtracted, we are going to do what? Reverse it. The underlying word is what? Reverse. We are not going to treat it. No. Reverse it. So look at the difference. So that's why the examiner assumes that you have done profit and loss. So you know how to treat certain transactions. So depreciation is aware that depreciation has been what? Subtracted from the profit. So what do you have to do? You add back to reverse it. You are not going to prepare the profit. No, not at all. Great. Impairment is non-cash. If they have subtracted it, You add back. Then inventory written down. All of these provisions, bad debt, provision for bad debt, all of these are what non-cash items, which must be what reversed. So that's all good. Item number 2, accruals and prepayments. Accruals and what? Prepayment. Make sure to reverse or to adjust the accruals and prepayments. Any expenses that they have not paid for it, but they have subtracted from this profit, what do I do? Reverse it, add it back to it. That is it. Accruals and prepayment. Accruals and what? Prepayment. Now the third item, I call it the stranger or alien. Alien. Any item which has entered this profit, but it's not. This one, let me explain this. When you look at cash flow has 3 perspectives, right? Operating, investing, and financing. But if you look at the profit statement, there's no 3 demarcation, or there's no operating profit, profit from investing, and profit from where? Financing, no. So the profit that you are going to make, it includes all these 3 items. So if there's any transaction which is for investing or financing, or one way or the other, that entered this profit, it must be reversed. And critical examples are the other incomes. All the other incomes must be reversed. Why? Because non-operating activity. We saw them under what? Under investing. So alien, the third one is what? Alien or strangers, items which enter the profit, but they are not operating activity. Either they are financing or they are investing. Critical examples are what? Investment income, profit on disposal, dividend, interest received. All of these items, they are added to the profit because you pass through the other income. That's why the examiner know that you prepare the profit or loss already. So other income, all the items that you have added into the other income, they are not operating activity. But because in our income statement or comprehensive income, we don't have operating section, investing section, and financing section. Everything goes together. So they are in this profit. So what do? They are reversing it. Send it where it's supposed to be. We are done. That's all. When you're done, let's your tax and then your interest from it. And then adjust for changes in working capital. Then that's all. So now let's put down some small format together. Good. So this is how we want the format to be. Please. This is how it's supposed to be. The first, tell the examiner that you are preparing cash flow from where? OA, operating activities, no shortcuts. Here the currencies. Normally we like to, for cash flow, we like to, especially with what? The indirect method from operating activity. First, which of the profit are you going to use? You have to pick one of the profits. We like the profit before tax. Profit before what? Tax. So I write here profit before tax. So profit before tax. We like that one. Because it is the operating profit just before tax. Is the one that we can pick and massage it. Not the profit after tax. How we get it? We like the profit before tax and massage this profit with interest. Have you seen profit before tax? It means that after interest, right? And interest is part of the adjustment. So we have to pick profit which is before tax, but after interest, so that we can massage everything together. For tax, that's its own issue. That's why we pick the profit immediately before tax. How we get it? Good. So let's put it here. Like this. Immediately. Yeah, immediately. Add back interest expense or finance cost. So immediately add what? Add back interest expense. Immediately. As soon as I write it again, I don't reinvest. Add the interest expense to it. That's the finance cost in a profit and loss statement. Interest expense. Immediately add it. As soon as you add this, I'm going to get one of the profit called profit before interest and tax. Profit before interest and tax. So profit before interest and tax. So much. So it means that thank you. So the question is, if we are looking for profit before interest and tax to massage, then why can't we pick just profit before interest and tax and then move on? But that says the standard IAS 7 cash flow statement. It's a format prescribed to us. However, if you pick profit before interest and tax, you are not wrong. Don't forget that you are sending 2 ticks home. Because these ticks will be missing from your section. Even though you are not wrong. So that is it. So that we should start from the profit before tax. Massage it quickly to get a profit before interest and tax. In fact, it is the profit before interest and tax that we want to massage, not the profit before tax. So that's why we have added back to get this profit and now adjustment. Let's go and then massage this. I wish I can do it though. So that is it. Now let's start the massage. So say adjustment for that is. So all the 3 items are listed down in them. So adjustment for 1, non-cash item. So examples of non-cash item. Let's give example. Depreciation. Almighty. So depreciation. Great. You can place the adjustment here. Or you can also place them here. Any of these two. Yeah, okay. So apart from depreciation, amortization, impairment, what again? Inventory written down, IAS 2, all of these examiners are aware that we have done it. Everything I've done, examiner is aware that we have done it. Including those that have not done it, also aware. Yes. So you bring those stuff in. Then provisions. Then accruals and prepayments, bring them in. Then don't forget your strangers. Investment income, they are reversing it. So investment income. Here, have you seen that we are adding left it positive, right? Good. So now we are adding, we are reversing it. Why? Depreciation has been what? Subtracted. So what do? We are adding back to turn it to its position. So that is it. Great. Now, investment income. Have they added to the profit or they have subtracted from the profit? They have added it, right? Good. What do? We subtract, reverse it. So if you see investment income in the profit and loss statement, just bring it here and put it in bracket nicely. They are reversing it. Why? It is alien. It's a stranger according to cash flow. Investment income as what? Investing, not what? Operating activity. But because our profit before tax or the profit before interest and tax includes it, we are reversing it and turn to the right position. That is all. Then profit or loss on disposal. So let's see, profit or loss on disposal. Good. Now let's see. If it's a profit, what do? If it's a loss, what do? So if it's a profit, they have added, right? So we subtract. If it's a profit, subtract. What if it's a loss? Add back, because loss has been subtracted from where? The profit. And all of this, the examiner is aware that we did that under what? IAS 16. How do you get it? That's the good news about it. Good. No, there's not now bring all the questions that's done. That's it. Okay. So we can continue the game. As soon as you are done, post it, send it to the other section. We are done with adjustment. Left the last adjustment. Let me do it here. The last adjustment. Let me do it here. Then you continue the game. You continue the game. The next section, there are some three stubborn guys. We call them working capital. So changes in working capital. Changes in working capital. Yes. So the next one will be changes in working capital. To analyze it, there are three items. Now let's perform some small exercise here. Small exercise. This thing you have to use red pen to write it. You have to use red pen to write this exercise. The exercise you are going to perform here. Good. Great. Okay, there's a question. Let's go and pick the question here. In fact, using direct method or indirect method must balance nicely for you. Get the same answer. The net cash flow from what operating activity will be the same, whether direct or indirect. There's a question here like that. So question 5. Yes, it will balance nicely for you, whether direct or indirect method. Just that not all information will allow you to prepare the cash flow under the direct method. The direct method requires certain extra information. How we get it? Like credit sales, like your purchases, like cost of sales. If I don't give you sales, I don't give you cost of sales or purchases, you cannot prepare the direct method. However, with that of the indirect method, I can just give you the profit before tax. That's all. In the income statement, and then I'll give it to you. You can easily prepare it. So that is it. Now let's perform this exercise. There are three items that form part of the working capital. We like three items. Item number 1, inventory. Item number 2, trade. I like this term. Trade receivable, not account receivable. And trade payable. Okay. These are the three working capital. If you get this one clear, you get 10 selects for free. 10 selects for free. Good. You can do that one first. Then you start the work before going to look for the profit before tax. Okay. Inventory, trade receivable, and trade payable. These two are common. This one is the odd, right? Current assets and what? Current liability, right? Okay, good. So locate them there. They say changes. Changes means increase or decrease. That is the changes. So what we do? So change simple means either it will increase or it will decrease. So it should tell us if inventory decreased over the period, is it inflow or outflow? That is all. Inflow or outflow, that is all. If inventory decreases, is it inflow or outflow? That's all. You don't need to learn everything. You just learn one. And it's the same for some and it's opposite for the other. Good. So that is it. Now, increase in inventory. Does it suggest that we are receiving money or rather money is what leaving the entity? Increase in inventory. When your inventory increases. At the start of the year, our inventory balance is 300. At the end, it has increased to what? 500 Ghana cedis. It has increased by 200. This 200, does it suggest that we have paid 200 or we have received 200? We have paid. because this goods was not there just magic. No. We bought additional goods of what 200. So we paid money. So cash has what moved. It was outflow. Outflow. And all outflows are what negative. I like that. Negative. So put it in brackets. It means that if your inventory increases, put it in brackets. What if it decreases? When inventory decreases, that becomes what? Inflow. That means money is coming in. Oh, that's positive inflow. That means sold some part of the goods, right? Yeah, that's why that's what decrease the money in. That's all. You should know only this. Your memory not enough to cover all this. So just know what you've done. That's all. If you understand this and I'm done. Inventory and receivable, they are twins. All of them are current assets, right? So what is good for inventory, also good for trade receivable. So they follow the same lane. So year two outflow, year two inflow. That's all how we get it. So when trade receivable also increases, it is what outflow. When it decreases, it's inflow. Now this is the meaning, this is the explanation. Trade receivable, someone that owes us or people that owes us. At the start of the year, 1,000 Ghana cedis, so trade receivable, 1,000 cedis. At the end, it has increased to 1,200. Wow. So it means that during the year, we sold goods costing what 200 to them without taking money, which increased the amount that they owe us from 1,000 Ghana to what 1,002. What is the implication? Does this suggest that we have spent money or we rather received money? We have spent money, right? But these goods, that 200 that we gave them, we bought it with physical cash and giving them to them on credit. So here it means that we have given them cash of 200, additional cash of 200 in the form of what? Goods. That's the interpretation. We have given them cash of 200 in the form of goods. So therefore, it must be what? Outflow. Good. What if it decrease? Maybe it decrease to 700. Oh, they pay us. We have forced them to pay what? 300 Ghana. That one is what? Inflow. So these two people, they move together because they are what? Assets. The opposite is true for what? Trade payable. Because this one is a current liability and current asset. So they are what? Two things. They are not the same. So the opposite. So if this is outflow, then here must be what? Inflow. Here must be what? Outflow. That's all. You are done. Now this is interpretation. Trade payable. Trade payable. Trade payable. Yeah. We are owing someone. At the start of the year, we owe the person 700. At the end, we are owing the person 800 as a result of goods acquired on credit. What does this suggest? It means that during the year, we bought additional goods of what 100 that paying for it. Wow. So what does it imply? Does it suggest that we have paid cash or we have rather received cash? Now the issue is this. The goods that the additional goods, we're supposed to give them money of 100. We have not given them that money, but we have enjoyed the goods. So we have received cash of 100 in the form of goods. But they also use money to acquire the goods and give it to us for credit. So we have received what money, an amount of 100 Ghana cedis in the form of goods. So therefore, it must be positive. Then the other section, if it decreases or goes down, maybe from 900 to 700, it suggests that during the year, they have forced us to pay what 200 out of what we owe them. So therefore, it was outflow. You are done. I'll be getting. So compare these balances and know them. All of them will give you 10 solid ticks. Now let me explain this. There's something that we have to take care of. The word trade. We want trade, either trade receivable or trade payable, not account receivable or account payable. Okay, let's write these things down. Can I take this section off the table off? Good. And then let me write these things down. Okay, but we're even going here. Don't worry. So trade receivable plus other receivable, maybe 300. Other receivable, 100. Total giving us what? 400. This is what we mean by account receivable. So in the question where the examiner gives you account receivable, please get the other receivable and take it off to get the trade receivable. We like the trade receivable. What's the meaning of trade receivable? Is the receivable or owings when someone owes you as a result of you selling what you just gave to the person. I buy and sell clothes. So trade receivable means people who are owing me as a result of what? Buying my clothes. That's all. Other receivable, maybe I sold my vehicle to someone and the person have paid, let's say 2,000. The person is owing me. It's also receivable. But that one is what? Other receivable, not trade. Good. It's not coming from my core activity. So it's other receivable. Here, don't forget that we are calculating what? Cash flow from where? Operating activity. So we are interested in the trade, not what? The other. So in exam, we will just tell you that the trade or the account receivable figure that you see there, it includes other receivable of what? 100 Ghana. So just go and take it off to arrive at what? The trade. The same thing applies to what? Trade payable. We don't want to see other payables in it. However, in questions where we still tell you trade and other receivable, but we don't give any information that will help you to get the trade receivable, use it like that. If you realize, let's go back to the illustration that we did. The example 1. Let's go there. Page 5. When you go to the example 1, you see that they say trade and other receivable, right? We just use like that too. But they didn't give us information for the other receivable. So just use like that. But if there's information there, I'll just take only what? The trade receivable. Agreed. We are done. So now let's continue the game. So let's finish the format quickly and start one. So when you go to the changes in the working capital, 3 items. So check the inventory. So either increase or decrease in what? In inventory. Open your brackets. Perform the working. Something minus something. Put the answer on the first section. Do the same for all the 3. The one that you sum them up, you get 10 ticks or 10 workings there. Good. So that is it. If inventory increases, we say what? Outflow, you subtract. If inventory decreases, it's what? Inflow. So we are saying increase or decrease. Good. So basically, that is it. Then we go to the same thing, increase or decrease in what? Trade receivable. If it is increase, you take it off, you decrease, you add. You go to the same thing for trade what? Payable. But for trade payable, if it increases, good news, oh, positive. If it decreases, it's negative. Then you add them, send them to the other section, and then you are done. See, this one is the first currency. This is the first currency. And then you get a second currency. You have to get a second currency. So we sum them up and place them at the second currency. So let me put them here. So finally, you add 3 items. First, your profit before interest and tax from the very first adjustment. Second, you add the adjustment to it. And lastly, you add the final answer of the working capital to it. Okay, these 3. So you analyze it again. Now we call it what? Operating cash flow before interest and tax. You've been able to massage this profit before interest and tax to get a cash flow version. So we call it operating cash flow before what? Interest and tax. Good. So we sum it up, then we call it what? Operating cash flow before interest and tax. So that means we're able to massage profit before interest and tax well to get what? The cash version of it with the help of the three items: non-cash, alien, and what? And accruals. That's all. Great. Good. Now we are going to move forward. So if this cash flow is before interest and tax, then what is the next item? As usual, interest paid, so much, and what? Tax paid. So tax paid, so much. Put them in brackets, check them off, and this is the final answer. We call it net cash flow from where? Operating activity, OA. No shortcuts in exams. No shortcuts in exams. Now let's pick the next illustration, example 3. Example 3, no, example 2. Example 2. So let's clear example 2 from the way. If you do have any question, any challenge with the format, can let me know. Please, cash flow or cash flow statement. The challenge is the cash flow of operating activity. It's very lengthy, especially the operating activity. If you use the indirect method, very lengthy. Good. So kindly take care or kindly take note of the operating activity and get everything there. If it's happening that your operating activity is correct, oh, the likelihood of scoring high in the cash flow is a bit high. So let's see. Okay, so example 3. Example 3. I will say example 3 instead of example 2. Instead of example 2. Let's go to example 2. Example 2. Example 2. The company has provided the following information. The company has provided you with the following information. And then the requirement says, prepare the statement of cash flow from where? From operating activity using the indirect method. Using the indirect method. So let's see. Let's see. So there's profit before tax there. There was depreciation on PPE, loss on sale of building, interest paid, interest expense, income tax paid, account receivable. All of them are the year-end balance. So now let's practice the game. So where are you going to start from? Profit before tax. Profit before tax. That's the standard IAS was 7 cash flow statement. Good. So statement of cash flow is being governed by IAS 7. So IAS 7 clear from the way. Good. So the name of the company must be there, and we have our statement of cash flow. So I'll just have to just be including the figures there, right? Just be inserting the figures. So then we are done. The profit before tax is 800, right? It is 800 Ghana cedis. 800 cedis. Add the interest expense. What is the interest expense from the question? I just have to insert the figures, then we are done. But let me do all. I like writing from here to here. Yes. I like writing from here to here. From here to here to here. No. But let's start all over again. Maybe writing from other section here. Now. Good. Okay. So let's see. First, cash flow from where? Or A. No shortcut. So I'll put my currency here and currency here. I'll tell the examiner that I need a profit before tax. The more I write, the more I remember. So I'll write profit before tax. I'll go to the person, then it's got 800. So let me put that one here, 800 Ghana cedis. Immediately, don't rest. Immediately, as soon as you place that in the figure or calculating for the figure, immediately add back what? The interest expense. Immediately look for it and add it to it. Add it to it. So interest expense is what? 300 Ghana cedis. So therefore, I'll add it 90,100 immediately. Don't rest it. We call this one what? Profit before interest and tax. So this profit is before interest and what? Tax. Then you are done. Then you start your massage. Let's start the adjustment. Let's start the adjustment. So tell the examiner that you are going to massage this profit, this adjustment with the difference to reconcile. So adjustment for first item on the list that you have to look out for is what? Depreciation. And thank God the examiner is aware that you've done it. Depreciation. Aware that you've done depreciation. No story of depreciation. The depreciation is 400. I'll put it here. You can also write it here. Good. Then the next item on the list, impairment or non-cash item, provisions. No. Okay, then we go to accruals and prepayment. No, for this question, no. Then you go to the alien or the strangers. Is there any stranger here? Any item which is not part of operating activity but is there? You can see loss on sale of what? Building. So loss on sale of what? Building. Good. Loss on sale of building. So loss of 200. What are we doing? So tell the examiner. Loss on sale of what? Building. Now, in this illustration, we have calculated everything for you. Example, we are not going to do that. Even if we are dashing math, we won't do it. You have to calculate because the examiner is aware that you've done IAS 16. How to calculate profit or loss on disposal. So that one is aware. Good. So loss on building is 300 and 200. You add or you subtract? You add because they have what? Subtracted it. So add back. They are reversing it. You are not going to pay profit or loss and reverse all they've done. Good. So is there any other item that we have to adjust? Basically, that's all for this particular question. What left is what? The changes in working capital, the 10 tick squad. The 10 tick squad. Let's see them. The 10 tick squad. the 10 ticks squared. Okay, so let's see. So you can sum them up, put them here, making what? 600, or you can add the change the capital to it. Here's what? 600. Yeah, to Tata. That is that I'm now on changes in what? Working capital. Working capital. So the three working capital. Inventory. I have to check inventory, check trade receivable, and check trade payable. Whether there has been any changes. Changes simply means the closing balance less or the opening balance, the movements, and like that. Good. Please, all what you need to know is whether it has increased or decreased. Just find the difference. If you know that it has increased or decreased, just find the difference. The rest is for the examiner. Good. So if you look at inventory, so let's see inventory whether it has increased or decreased. Please check it first before you write it. So inventory at the year end is what? 800. At the beginning is what? 1000. So the inventory has what? Decrease. So decrease from where? 1000 to 800. So tell the examiner that decrease in inventory. Decrease in inventory. And open a bracket nicely. Open a bracket nicely. Then just find the difference. Minus 800. Put it there, 200. Now, decrease in inventory. Will it be inflow or outflow? Good. Decrease in inventory. Will it be inflow or outflow? Is money coming in or money is going out? So it's what? Inflow. Agreed. So inflow. So positive. That one, leave it like that. So inflows are positive. So leave it positive like this. Then that is all great. Then what about trade receivable? Let's go do the trade receivable. Let's move together. Trade receivable. Here they said account receivable. So they have to give us the other receivable. It's not there. So you have to use it like that. Account receivable at the year end is 1007. At the beginning is what? 1000. So that's increased by what? 700. So here increase in receivable. So increase in receivable down to 1007 less 1000. That will give us 700. Agreed. I like the working, so I like them more than the final answer. But together the working to give you 9 solid, 6 solid ticks out of the 10. Now let's see. The next one is trade payable. So account payable at the year end is what? 1000. But at the start is what? 400. So that's what? Increased by what? 600. So tell the examiner that increase in what? Payable or trade payable or account payable. So by 1000 less what? 1000 less 400. Good. So 400. By so you put 600 here. So ask yourself, the trade receivable, if it increases, is it inflow or outflow? It's outflow. To put that one in bracket nicely. Then the trade payable, that one is inflow. So you add. So at the end of the day, you get positive 200 minus 700 plus 600. That will give us positive what? 100. So these are the 10 ticks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 free ticks. Just fine it. So make sure that you do all the work in here. However, if you pick your calculator, and you punch it and throw in the answer, it won't give it to you. Yes, we only give you or give ethics for what you see there. Good. Now put all these three things together. Change working capital, net of the adjustment, the profit before interest and tax, put them together, then we call them what? We call them we call it what? Operating cash flow before interest and what? Tax. Mhm. Good. How to find the changes? Changes means the new manage the old. However, that rule will not work here. If you can tell us the increase or decrease, just find the difference. So anyone that find the difference. So it can be the beginning minus the end or end minus the beginning. So long as you know that it has increased and you know increase are either inflow or outflow, it ends there. How we get it? Yes, that is the rule for that of change. But here, as long as you know that increase or decrease. Now let me give you a trick or a secret over here. When you go, and the question is that when you get to this section, just find their difference and write them positive there without making a decision whether it's inflow or outflow. When they are done, then you check, okay, so even if it increases, then if it increases outflow, then come and put it there. If you calculate it like that and leave it for at least some of them will correct, some of them will not. Then square everything wrong. Good. So just find their difference. Anything minus anything. Please don't want any negative. Like this minus this, put another deposit. 1,007 minus 1,000. Obviously, I put it 700 here, right? Obviously, here, I was just subtracting that in the day. I get positive figure here, right? Good. Then I put the answer there. When I'm done, then I'll now ask myself, has the event decrease or increase? Oh, it increases. Increases means outflow. Now start coming back to put the negative among them. So even if I forgot to put a negative there, at least these two workings, I'll score them before this one. Good. So that is it. Okay, now let's put them together. So 1,100 plus 600, 1,007 plus 100, 1,008. So this one give us 1,800. Great. So that's the operating cash flow before what? Interest and what? Tax. Now let's move on with the game. We are moving on. So if this cash flow is before interest and tax, what's the next item? That was interest paid and tax paid, the last line item. Good. So if you're able to multiply this profit before interest and tax to get what? Operating cash flow before interest and tax. That is good news and super fantastic. So interest paid and tax paid. So interest paid and then finally tax paid. Good. So interest paid on the question is interest paid 200. I'll put it here. 200. And then tax paid is what? 100. So I will subtract it. So it's not going to, but let me record them there. But let me just take them off. Everything too small. I can't even see. So I'm continuing from here. So interest paid happy to be 200. I will subtract it. Tell examiner that tax paid too must also be subtracted. So then final answer 1008 minus 300 will give us 1005. That is that is the net cash flow from where? Operating activities. Then we are done with. Yeah. Net cash inflow from the operating activities. Great. Okay. So this is the end of the section. What left is for us to pick a full question and do justice to them. So that's great. Okay, great. So now let's back it with what? Full exam illustration question. So let's go to this question. Example 4, Adam Limited. Sorry, Pearl Limited. Pearl Limited. Pearl. Okay, let's go straight and read the requirements. The requirement says that, where's the requirement? It's just at the bottom. Okay, it's here. Prepare the company statement of cash flow for the year ended 31st December 2005 using what? The indirect method. Adopting the format of what? IAS 7. That's serious what? IAS 7. In accordance with what? IAS 7 statement of cash flow. So can you use the format provided? Great. So that is it. So right after the requirement, then you set the tone. With the cash flow, can you use minimum of 2 pages, maximum of 3 pages to avoid trouble? So for the statement on its own, 2 pages. So first page, second page will cover. Your working start from where? The third page going. Don't say that me, I'll not do any workings. That's what we are looking for. So that's the tone. Then as usual, the rat or the RAF requirement, additional information, the trial balance or the financial statement. For cash flow, they will give you financial statement. So that becomes RAF. Great. So let's go to the footnotes and start reading them. Note 1. During the year, non-current asset which had the cost of 800,000 with a current value of 350,000 were sold for 500,000. So here, first thing that you have to do is to calculate the profit or loss on disposal, right? So how do you get the profit or loss on disposal? That's why we said that the examiner assumes that you've done IAS 16 profit and loss on disposal. So how do you calculate it? The proceeds, how much was sold for? It was sold for 500,000 less what? The carrying amount. What is the carrying amount of the asset that they sold? The carrying amount is what? 350,000 given to us free of charge. So what do we do towards the profit? So 500,000 less 350, that's what? 150. So there's a profit on what? On disposal. So the profit from that is the where are you going to treat it? Adjustment. So good. So adjustment, you have to reverse it like the way we did for the loss on sale of building. So here becomes profit on disposal. You perform your calculation, it will be 500 Ghana less the 350. I'll get what? 150. Thank God. Because it is a profit. They have done what? They have added it. So I'll do what? I'll subtract. That's the end of the game. I'm done with that note. Again, the proceeds. We said that this one is alien, it's a stranger, supposed not be part of what operating activity. When you go to investing activity, right? The proceeds must be part of what investing activity. Great. So if you continue, when you go to investing activity, when I go to investing activity, in fact, you're going to solve this question fully. I just explaining it. So investing activity. Tell the examiner that proceed from where disposed they sold it for 500. You put it there, it ends there. How we get it? So this is how you are going to do the game. Now the cost of 800,000. In fact, you needed to calculate the acquisition of PPE. In fact, that one we have the cost method and the current amount method. I strongly advise for the current amount, so the cost will not be needed. You're not going to touch the cost. You only touch the cost if you're looking for the accumulated depreciation of the disposed assets. In this case, how are you going to find the accumulated depreciation of the disposed asset? The asset cost, we don't know. In fact, we know the cost of what? 800. Accumulated depreciation, we don't know. And they have subtracted it, and they had a current amount of what? Of 350. So therefore, what is the accumulated depreciation? So if you are looking for the accumulated depreciation of the disposed asset, that is the difference, and you are done. That is 450, right? Great. So you are going to use the cost to calculate the accumulated depreciation of the disposed asset. Okay, now let's continue the game. So note 1 is cleared from the way. Let's go to note 2. The capital surplus increased from the revaluation of some land that was not being depreciated. So you go to the financial statement, the examiner said capital surplus, locate capital surplus. So let's go to the financial position, the balance sheet. You can see capital surplus there. It has moved from where? 1,000 to 1,005. So that means current year is 2005. Previous year is 2004. So in 2004, it was 1,000. In 2005, it's 1,005. So that's increased by what? 500. That means they did revaluation and they had a revaluation gain of what? 500. How do you treat revaluation gain? You add it to OCI and do what? Add OCI and add it to the asset value, right? Good. Yeah, the OCI, they've done it correctly. So that's what they've added and they had 1,005. So we have to now add it to the PP when we are going to calculate the acquisition of PP. That's the next section. It will be under investment activity. In fact, under investment activity, we have to calculate what we call acquisition of PP. That one, the examiner will not inform you. You have to calculate it by yourself. Good. Yes, we are not going to reverse revaluation surplus because that one will be accounted from what? OCI. The examiner is aware that you've done OCI. So you know that revaluation gain goes there, right? If we touch it and reverse it, then we got you nicely. Then we do our thing. Good. However, if it's a reverse, then it must go there. What if it's what revaluation loss? I like that. What do you do? Revaluation loss has been added to the operating cost. So therefore, it has been what? Affected. So it has been subtracted from the profit. What do? You add back because revaluation loss, there's no money in revaluation loss. You are just lying to yourself that the value of your building or your asset is not the same as the market value, you are losing. Nobody has subtracted it from your cash. So it's not a cash flow. So let's reverse it. Good. So basically that is it. So in this case, just use the difference of 500 to top it up and then top it up to that of the PP calculation. Okay. Then note number 3. Note number 3. It states that the 2004 income tax liability was the liability, sorry, in fact, was double counting, right? Yes, double counting. So let's take one off. So 2004 income tax liability was settled at the amount provided for at 31st December 2004. For this note, you don't need to touch it. It will be a confirmation. They are just saying that in 2005, the only tax that they paid was the 2004 tax. So it means that the tax provided for 2005 will be the income tax expense or the liability, the only liability at the end of the year. And such note, it will confirm 2004 and 2005. So like it goes like this: the income tax liability was settled at an amount provided for at what 31st December 2004. Okay, so please here too, if you are looking for the tax paid, sorry, where are we? Sorry. If you are looking for the tax paid, you have to also follow the same scenario. Open balance, closing balance, the income tax expense, and then the tax paid. So how do you get the open balance? Go to the financial position. Open balance is the previous years. That's the open balance. So you go to the financial position. If you're looking for income taxes there among the current liabilities, you can see open balance is 600 and closing balance is what? 700. Then you go to your income statement. This is summarized statement of comprehensive income for the year ended 31st December 2005. Then you pick the income tax expense, which is what? 700. So you add it and now subtract the closing balance of 700. So it will confirm that the only tax that they paid is for 600, which is the 2004. And that was the note that they are telling us. They're just telling us that the only tax that they paid in 2005, which is the current year, is the last year tax that they provided, which was what? The 600. And the calculation confirmed that. Let's back it into calculation. So if you are calculating for the income tax paid, in which you do it, the tax paid, tell the examiner that you need the open balance. The open balance was 600. You need the income tax expense, which is 700, less the closing balance. As the income tax liability is also 700. It confirmed that the previous balance is the one that is paid during the year. So this one becomes tax paid. So just a confirmation examiner was informing you. Good. So tax paid, you know where to go, right? And our operating expenses. Hey, operating cash flow. Yes, operating cash flow. Now let's move on with the game. The game is getting interesting. Now note what? Note 4. The additional loan notes were issued on January 2005. Interest was paid on 30th June 2005 and 31st December 2005. So first you check additional loan. So let's go to the financial position, locate the loan. Loan is non-current liability. So quickly we go to non-current liability. Yeah, the examiner assumes that when it comes to financial statement preparation, especially balance sheet and income statement, you are superb there. So it can be moving you. So 10% loan note. At the start it was what 2,000. At the end it is what 3,000. So it means that they have what secured an additional loan of what 1,000 during the year. Where do you send that one to? Loan, acquisition of loan. You go to where? Financing. So that's the cash flow from where? Financing, right? Acquisition of loan note. Then you open a bracket, 3,000 minus what? 2,000. Then you put 1,000 there, positive. Perfect. Then you are done. Now let's continue the game. The interest that they put there, once you have interest expense in the in the financial statement like this, you don't need to worry about the calculation of the interest. If you want to calculate it, you can do 10% of 3,000 give us what? 300, and that's the interest expense you see there. Great. And then they pay 150 in June, 150 also be paid in where? 31st December. So now, if we check the financial position among the current liabilities and you don't see interest there, then it suggests that there's no interest liability. They are not owing interest. And if you are not owing interest, what you paid is equal to the expense. Now there's two different items here. You have what we call interest expense. At the point in time, we call it interest expense. The latter part, we call it what? Interest paid. What's the difference? Interest expense is the one that you see in the P&L. Any interest that you see in the P&L is called interest expense. It's also called interest incurred. What you're supposed to pay. Interest paid is the actual payment. Where can you see this? It's in the cash book. But because we want to trouble you, the cash book is hidden. Only financial statement given to you. You can't find it. You have to calculate it yourself. How do you get interest paid? We said that anytime you look for something paid or something received, the open balance, it will be a liability. So check the current liability and then locate it. So interest paid will be open balance, add the interest expense to it. So interest expense less what? The closing balance you are done. So this becomes the interest paid. Now, I was making point that anytime there's no interest owed on the balance sheet, no open balance, no closing balance, then the interest expense will be the same as what? Interest paid. That means you paid all the interest or not owing them. So that means the expense is the same as what? The paid. So that is it. And this question, that's how. So that means interest expense is 300, interest paid is 300. Everything will be 300. Interest paid is 300, interest expense 300. What is the confirmation? The confirmation is that the current liability, I don't see interest there. There's no interest at the current liability. So nothing suggests that they are owing interest. So they are not owing any interest. If they are owing it to be part of what? The current liability. I don't see it here. So they are not owing interest. And the examiner said it. He informed us in the note. He said that additional loan notes were issued on January 2005. Full stop. Interest was paid. I like that. Interest was paid on 30th June 2005 and 31st December 2005. We are done. Dividend paid during the year amounted to 750,000. That's a note 5. Where are you going to treat it? Note 5. Dividend paid amounting to what? 750,000 cedis. Great. So dividend paid will be under what? Financing activity, which is what? Outflow. So put in brackets. You are done. So that's the end of the footnote. We've gone through all of them. Now, as usual, graph. So let's go and scan to the financial statement. Now, for cash flow, first, they'll give you income statement. Let me go to the income statement section first. Comprehensive income. Here, you need only the current year for comprehensive income. You need what? The current year. When I give you double year for income statement, please just pick what? The current year item, not what? The previous year. Good. So the income statement that will give us, we have to select the profit before tax. So that's what we need there, and any other alien item. So in this question, what's the profit before tax? You can tell me. That's the 2,350. But if no name it, it's also part of what the question, part of the game. But the examiner is fully aware that you've done comprehensive income, and you know that right after finance costs, any profit that comes before profit before interest, before tax, or right before income tax, any profit which is there, it is what? Profit before tax. How you get it? Good. Or you can just pick the profit after tax and add back the tax. You get what? Profit before tax. Great. So that is it. And then the interest is finance cost. Sometimes if the examiner is in good mood, he will list the other income item there for you. Investment income. You see it in the profit and loss statement. You see the comprehensive income. So if you see other income such as what? Investment income, interest receipt, dividend receipt, all of these you reverse it. Like Mo Limited. Let's go to Mo Limited. Can we, in fact, Adam Limited, example 5 is there. You can see there's gain from disposal of asset 990, right? If you go to Adam Limited, gain from disposal of asset 990 is there nicely. So they've done it for us. If you go to the next example, example 6, Mo Limited. Mo Limited to they did the same thing there, Mo Limited. If you go to Mo Limited, you can see investment income there, 1,100 and 700, right? And it provided a detail. All this might be what? Reversed, but they don't form part of what? The operating activity. Other incomes do not form part of the operating activity. Good. So now let's continue our game. So let's go back to Pearl Limited. Madam Pearl Limited. So right after the income statement scanning, when you're scanning to the income statement, please look for 3 items. 1, your profit before tax. 2, the finance cost or the interest expense, because immediately you have to add it. Then the third one, look for the alien items, whether there's other income stated there. Any other income that you see in a comprehensive income, can you lift it and go and reverse it in the what? Operating activities among the adjustments. Then you quickly go to the financial position. However, for the financial position, because of the open balance and closing balance, you need 2 years. Current year and the previous year. How we get what? Because of what? Open balance and what? Closing balance. That is all. Good. So non-current asset, the cost is there. In fact, cost or valuation. The slide error, the cost or valuation. Cost/valuation. So either the cost of the asset or valuation, that means revaluation. That means certain year they did valuation. Good. Accumulated depreciation is there. So the current amount of the asset has been provided. So you compare. Here, you use it to prepare what you call acquisition of what? Of non-current assets. You have to know whether they've acquired asset during the year, because if they've acquired asset, it's what? Investing activity. Good. How do you know whether they've acquired asset during the year? Relax. Let me prepare that one here. Bring the open balance of the asset carrying amount. Open balance is what? 3,200. Ask yourself, is there any item in the footnote that will affect this guy? Have they disposed asset during the year? Oh yes, they've sold asset. Subtract it. Find the current amount of the disposed asset. Take it off from this figure. Is there any revaluation during the year? Yes, they did valuation. They had a gain of what? 500. Add it. Good. Is there any depreciation charge during the year? Yes, they charge depreciation. Subtract it. At the end of the day, if that answer is not equal to what? 5,400, the difference represents what? Acquisition of what? PP during the year. You put it there under what? Investing. And then you put in what? In bracket as what? As outflow. Then you are done. Basically, that is it. So that's all for the non-current asset. Current asset, inventory, receivable, these two, you use it to calculate what? Changes in working capital. So here, open balance is 3,800. Inventory as what? Decrease over the period. Inflow or outflow? Inflow, you add it. You find the difference. Just find the difference. You are done. And call it decrease in inventory. 3,800 less 3,400. You put it there as positive figure. You are done. Receivable as increase, right? Which is what? Outflow. You are done. Cash at bank and cash in hand, we will do the balancing when we pick a fourth session. So we balance it off. Good. Let's continue the game. So from there, then you move on to, when you go to equity section, the stated capital, yeah, it has not moved, right? So stated capital is still the same. 1,000 at the start, 1,000 at the end. So that means during the year, there's no issue any shares. So you move on. Then you go to capital surplus. We talk about that. Income surplus, because they've given us dividend and then there's comprehensive income, you move on. Non-current liability, check. It has increased, right? It says you go to where? Financing. Current liabilities, trade payable. Now you compare and add it to the changes in working capital. Trade payable has what? Increased by 500, which is what? Inflow, because money is coming in the form of goods. Income tax, talk about that, and that's the end of the game. Then you balance it nice. Good. On that note, we are ending here, but you are not ending there. You are going to do this question fully. And then next week, I'll solve just one question fully on that. Then we are done with cash flow. 4 questions on that. Then move on to ratios. So next week I'll start with the ratios. I'll forward the ratios videos on the page during the week. Kindly go through before next week. Good. You are doing Pearl Limited. You are doing Pearl Limited. When you are done, for the week is too long, 7 days, right? So let's see. You do Pearl Limited. When you are done, then do as if you are doing, you are not doing. Then do Add-on Limited. Add-on Limited, question 5. Then if you thank me with more, I'll be very happy. Then question 6. In fact, we are doing 3 questions. We are doing 3 questions. Pearl Limited, Add-on Limited, and More Limited. I'll solve one of these 3 questions next week. I'll solve one. Yes. The one that everybody touches it, that's the one that I'll solve. Good. But the good news is that all of them, their videos are available. All of them. So can walk you through. So on the page, I sent some list of videos on cash flow. Chapter 1 is the introduction. Then the part 2 is Pearl. Part 3 is abdomen, and part 4 is move. So all of these are the solutions. Great. So that is it. Great. So you can use that one so that next week we are doing ratios. Wow. Then we are packing the financial reporting section some end. Then quickly start with the management, then the MPV section. Good. Great.